Atul Tantia, Group CFO of GPT Infra, is now joining us. Atul, afternoon. Thanks so much for your time. I saw that out of the 500 odd crore order you got, your share was just 200 something. Talk to us about this line of business. How much, what is the visibility on new orders, and what kind of margins are these orders coming at?
Sure, thank you. So in terms of this order, this is a 486 crore order from Central Railway for construction of a new railway line, broad gauge railway line of approximately 28 kilometers. Our share in this joint venture is about 26%, which translates to about 127 crores. In terms of the outlook, we have an order book outstanding of more than 3,000 crores, and we expect new order inflows in this year to be quite healthy as well, given the government's focus on this sector. We are primarily into roads and railways, with railways contributing almost 60-65% of our order book, and the balance being from the road sector.
You're saying you're expecting healthy order inflow. Talk to us a bit more about that in terms of what the pipeline is, what is the target with respect to order inflow. And I remember you had given us a long-term revenue target of almost 1,000 crore rupees. When do you achieve that?
So I think we are still in the silent period in terms of the Q4. Last year we had done revenue of almost 800 crores, and we had guided and we had achieved more than 700 crores in the 9 months ended December 31st. For the full year FY24, we have already guided that we would achieve the 1,000 crore number, and I think that we are on track for the full year in terms of FY24. We have a scheduled board meeting in the middle of May, and we'll come to the market with the numbers as and when that board meeting happens. In terms of the long-term target, we believe that this is a sector which is quite promising for the country, and there's a lot of development happening. And we expect the revenues to grow in tandem with the sector. And we would be expecting revenues to grow by almost 20-25% CAGR over the next 3 years from here on.
Revenue growth on a CAGR basis going forward. Let's talk about the long term. Let's not talk about short term because you are in silent period, but long term vision. If your revenues grow at 25% next 3-4 years, in what ratio does your profitability grow?
So there will be obviously some operating leverage that will kick in with the revenue growth. We have a hurdle rate of EBITDA of 13% for the new contracts and the existing contracts as well. And we have been meeting that hurdle rate for almost a decade now. So we would be at EBITDA level, we would be almost at the 13% with the new orders as well. And we expect, obviously, with the operating leverage kicking in, the PBT and the PAT to grow disproportionately.
Okay, point taken. So that's the kind of visibility that you're seeing over the next course of 3-4 years. But talk to me about whether you are well funded for all of this. With respect to the capacity utilization, what does it stand at? And at any point of time, would you perhaps be looking at a fundraise or probably getting in some partner to kind of augment your growth?
So we are our balance sheet is quite healthy. We are not very over leveraged, I would say. We have a debt equity which is less than 1x, almost 0.6, 0.7x, and that is quite healthy for the sector. Our interest cost is also quite checked compared to where it was earlier. So our interest cost would be around the 2.75 to 3% mark in terms of interest cost to revenue, which I think that helps us in order to fund the new contracts that we are getting in terms of working capital. This is a sector which primarily relies on working capital rather than term loans. So we are quite well funded to achieve this growth path.
All right, Atul, we'll be tracking that progress very closely. But thanks very much for your time. Sure. 65% of their order book is actually from railway. So railway EPC infra company, that's something to watch out for, and very comfortable visibility of 25% top line growth. Let's move on and focus on the big story of.
If you like this video, then like, share and subscribe to ET Now.